Hello and welcome to BQ Prime. A very good morning to all the viewers. I'm Hiral Dadia. Overall, a good day for the markets, a good start to the July series as well, with markets starting at fresh record high levels. Overall, this momentum is something, whether it's sustainable or not, is what we need to see. But clearly, we are trading above those 19,000 levels, and closing above 19,000 was also going to be important. Almost a 0.5% up move coming in terms of Bank Nifty, and we are above those 44,500 mark. Advanced decline ratio also pretty much in favor of the bulls in today's session. To join us, to discuss the stocks which are in action today, Samir Dalal joins in. Samir, good morning and welcome to the show.
Good morning. Thank you for having me on the show.
Samir, always a pleasure. Samir, let's start with the HDFC twins. They have been in focus, and it's Bank Nifty which has been participating in the rally as well, which is helping us scale new highs. Specifically from the HDFC twins perspective, what would you advise investors to do?
So the HDFC twins are actually trading at a deep discount to what their historical valuations are, right? So on that basis, we are getting them at a good price if you look at it from a valuation historical basis. I guess where a little bit of, the stocks have run up a bit in the recent past, no doubt, but I guess where there's still a little bit of, conviction lacking, or not conviction, but the reason that the stock hasn't seen a tear out rally has been the fact that once the two stocks merge, a lot of the mutual fund houses that have invested in both of the stocks will see their holding going about 10% in HDFC Bank, the combined holding. So, there's a little bit of a worry that there might be some selling that comes from there because some of them are not allowed to hold more than X amount of percent in any particular stock. And I think that to some extent is putting a little bit of pressure on the stock. The second thing that is there is, once the merger is complete, HDFC, which used to be a pure housing finance company, has a lot of these papers which eventually have higher costs compared to what the borrowing of HDFC Bank is. And till all of those papers mature and HDFC Bank is able to replace that with the low cost borrowing, the real benefit of the merger will not factor in the financials. It will take time for it to happen. So I guess those are the two reasons the stock is probably trading at a discount to what it historically used to trade at. And we believe that over the next 2 years, you will see, or 2 to 3 years, you'll see all of these things starting to settle out, and you'll start seeing the valuation starting to move up. So if you are an investor in HDFC Bank or HDFC, stay put, because we believe the future in maybe over the next 2 years is still very good, and there's good upside. You could probably get over 15% CAGR return over the next 2 to 3 years. However, if you're looking to buy, I wouldn't be surprised if we first see a dip in the stock. So wait for that dip to come. It won't be a deep dip. It'll be maybe a 3 to 5% correction from the current levels, which it was trading at maybe about 15 days ago. That might be the ideal time to get into HDFC Bank. But overall, we are positive on the business for the company, for the bank, and we are positive on the entire banking space. And HDFC is the leader in the space at the end.
Right. So that's with regards to the mega merger that everyone's eyeing. Moving on, MCX is also a stock of the day. With the extension of the contract with 63 Moons, clearly, what do you make of this? Because clearly brokerages are saying that FY24 earnings will be impacted. However, the long-term profitability does remain intact. How would you look at both these counters?
So 63 Moons I would not recommend, but MCX, yes, it's a very unfortunate thing. It's been almost, I think, 5 quarters or 6 quarters where they've had to pay a higher amount of money to 63 Moons to get the software. TCS has not been able to deliver it in time, and because of which what we are seeing is the profitability being eroded for MCX. This year they may very well report a negative earning at the end of the year, so that kind of is a dampener. But when you look at it, like you said, what your question was very rightly phrased, I would say, that what should you do on the longer term? Because eventually the longer term prospects is what we invest for, not the short term aberrations. Yes, they have some pain in them in the near term, and that the stock is reflecting today. But MCX is the largest commodity exchange in India, controlling about 93% of all volumes that happen. If you look at it in the oil and gas, if you look at it in the gold, I think they control almost 98 to 99% of the volume. And these are the segments of commodity which are going to continue to see more activities happening. Now, as the volumes on these exchanges keep growing, MCX, which is an exchange, will start keep earning its little bit of the revenue. It's a very small percentage of the trading volume that they earn. They'll keep in earning that. So we believe that long term for commodities in India has a huge opportunity to grow. So from the longer term perspective, we are quite positive. But till all of these matters resolve, I think there will be some sort of an overhang on the stock and you won't see a tearaway rally. So there's no need to immediately go and invest or buy this dip that has happened. I think any investor will have time to buy into MCX. Long term, again, we are positive, similar kind of talk that we had about HDFC. But I think the next 6 months is going to be something that we would like to wait and watch to see. Because if the software of TCS, which they've tied up for, does start getting traction, then it might make sense to start getting in because then the cost savings will start coming in the future years. So the earnings will improve and then the valuations, it won't look as expensive. But I think for the current year, FY24, we could assume that it's going to be very poor earnings. And if you look at price to earning multiple alone, I think the stock is quite expensive. So wait a bit, wait for 3 months, 6 months, let the exchanges come out and say, let MCX come out and say that, look, we are done. Now TCS software is up and running. And then make an investment into MCX because we believe the long term is good.
Right, so that's with regards to where MCX goes. Another one that is in focus is the easy trip planners. Samir, this week itself, we've seen two large block deals that have happened on this counter. From a business perspective, what would you advise an investor to do? Because clearly, if you see the YTD performance, it's almost a 20 to 25% kind of erosion in terms of the stock price. How are you looking at an easy trip planner?
So the travel industry is actually quite is in a very sweet spot, right?
Hmm.
The big problem for easy trip planners is purely the valuation multiples that they have been trading at. Look, so I think we're seeing a correction there. What we like about the businesses of easy trip planner, right? One, it's a low capital business. So whatever capital we've had to put into for the business has been put in. They have their website up and running. Now what they do is they sell tickets, they help people book hotels, and all of that leads to revenue generation. Where they have to spend money is advertisements to bring people onto their portal rather than any other, because there are lots of competing portals, and ensure that people execute trades or, purchase their hotels, tickets, and all of those products on their website. Now, I am actually one of the consumers of Easy Trip Planner. Apart from that, I also use Make My Trip and a couple other websites. And what I have seen historically is Easy Trip Planner is very, how do I put it, very clean in the way they present what they are offering to the customer compared to some of the other companies where the cancellation charges are not very clearly evident. Certain charges come up onto the ticket price only after you click a particular amount of clicks to get to that point, and then they add on some other taxes. Whereas Easy Trip Planner puts them all in right in the front, so you know actually what you're going to pay. So from that perspective, I think Easy Trip Planner has done a great job. Uh, Again, travel and tourism in India is something that will grow. So Easy Trip Planner will continue to probably grow its businesses. Of course, what we need to see is whether they're able to capture more market share, which I don't think is going to be a difficult thing to do as more people move away from traditional travel agents where you call up and you book your ticket, rather to booking your tickets and travel and everything directly. That very possibly happens. So Easy Trip Planners has good operating leverage. Again, valuations were a little rich. They've come off a bit. I still believe they're I'll not say on the very expensive side, but yes, they are still expensive. So you might see a further correction in the stock overall, but net, it's a good space to be. But wait, I think again, wait a bit. The correction, according to me, is not totally done, and we could probably see a bit more pain before we start seeing consolidating and moving back up.
Right. So moving on from there on, TD Power Systems had a block in today's session as well. How are you looking at the stock and what would you advise?
So unfortunately, we don't have coverage on TD Power Systems, and I don't have a view on that stock at all.
Sure, we'll miss that one. Indigo is another one where a lot of positive brokerage reports, Samir, that we've been seeing, and this is post the Paris Air Show, with the kind of orders that have been given out, the way ticket prices are panning out as well. From a valuation perspective, if you have to look at an Indigo, is it still a good time to enter the stock?
Valuation basis though. But look, again, we are playing in, see, in India, a lot of the times, why do we pay high valuation
Mm.
multiples? It is simply because we believe that the growth opportunity that exists in India is far higher for a lot of the spaces than it does everywhere else. Today, we have very small percentage of the people who are still flying by airlines, right? Bulk of it, a lot of it is still by rail, road, and various other means within the domestic economy. Now, with Indigo making a purchase for an additional 500 planes, that kind of tells you what they're expecting to happen over the next many years. As more and more consumers start for leisure travel, business travel, and the various other things, start using their services. If you also look at it internationally today, uh, ticket prices have soared quite significantly, and everyone's looking for a cheaper, slightly cheaper alternative. And Indigo fits that bill in a perfect way that it is a low cost carrier, right? So it does it. It's a no frill airline. It has standard operating procedure. I mean, like seats are particular. You get this. You don't have to. There's no business class. There's no none of that. So it's a very interesting play on the business. We believe it will grow. But like you rightfully said, on the valuation basis, I would not be buying it. I think a lot of the positives have already been factored into the growth aspect. The only thing that's going for it and why we believe that valuations may sustain at these higher levels, which is at the moment, is that it's kind of become a two pony race in the Indian aviation space with Go Airways struggling. Of course, they've got some amount of money assigned to them by the banks, but Go Airways on its way out. Uh, Other airlines like Jet Airways, they talked about a revival, but we don't see any light of day on that. So it's basically Air India, Vistara, which is one large block, and Indigo, which is the other. And then you, of course, have small regional players and maybe Akasa that's trying, but I don't think they will be able to compete with the likes of Indigo and Air India, Vistara merge. So from that being a two-horse race, kind of, I think people are quite bullish on the fact that they will be the largest benefactors out of this, and that is why valuations continue to remain high. It needs to be seen, of course, how competition comes out, how ticket prices work out, how fuel. There's so many variables that we constantly have to keep watching. If fuel prices move up, if oil and gas prices move up, of course, it hurts them. They've also got a little bit of benefit in the near term because crude prices have come down, and usually they do 3-month contracts for their oil. So they've got a slight bit of benefit coming their way. But we believe all of these things will start uh, waning off, and at the end of the day, I think valuations is something one needs to look at. So I would avoid an Indigo. It's a great company, doing really well, but for the time being, with valuations where they are, I would not be looking to invest in them at all.
Right, and you already have a Spice Jet which has come out with a notification which is delayed FY23 numbers because one of the auditors has fallen sick. So that's the state overall that we're looking at. But moving on from the pharma pack, Samir, you have a Aurobindo Pharma. USFDA has uncovered fresh faults at their Anakapalli facility, which does manufacture a couple of APIs, and their arm in Puerto Rico has halted production with regards to expansion work. Now, this is the second largest company as well in terms of where India goes. How are you looking at Aurobindo Pharma?
So Aurobindo in particular has always, I mean, if you look at the last 5 years of Aurobindo Pharma, they've always had some problem with the US FDA. They are one of the largest players when it comes to filings in the US, which is the biggest market for pharma and all of these kind of things. Drug sales. But at the end of the day, when you have constant problems with US FDA, your compliance issues are not taken care of, and even after having it for 5 years, you still keep making the repeated mistakes. I think that kind of is a bit of a downer, if you ask me, when it comes to the stock. Whereas Sun Pharma, to some extent, has, of course, resolved a lot of their problems. They can always come back. I'm not saying Sun Pharma is the gold standard, but for the time being, what they've done is, of course, far better. So if I were to look at the entire pharma space, I would definitely look at companies which focus on the US. So you have the Lupin, Cipla, you have Sun Pharma, Aurobindo, you have Natco Pharma, you have Ipca Labs, but Ipca Labs has had its own share of problems. In fact, one of their plants was just given 8 FDA, not warning, but 8 FDA sightings at one of their plants. So I think what we need to focus on is where US FDA inspections lead to the least amount of negative news flows, and that has been Sun Pharma. To some extent, it's been Torrent Pharma. Torrent Pharma has been quite good with their compliance work when it comes to US. And at the end of the day, what I keep saying is the US market is the biggest market where you have these large medicines, which still like $10 billion medicines, which are coming off patent, which are opportunities to cater to. Lupin just won one of the got one of the ANDAs cleared, so there's a huge opportunity for them to create that generic market and make profitability from that. So it's going to have to be more specific to which drugs are getting clearances at what time. But on a longer basis, I still feel there is pain point in pharma. Aurobindo is not something I'm very excited about, but Sun Pharma is something I would look at because of the kind of product model and the business model that he's made for himself.
Right. And my last talk coming that we want to discuss is ICICI Bank, who's approved the delisting of ICICI Securities. What do you make of the swap ratio, 67:100? I mean, how do you look at that one?
So honestly, if you ask me, I think it's a very favorable one, right? So let's go back 5 days, and ICICI Securities was trading at 520 rupees. Just because of this news, it moved up to 620 odd or whatever. Now, if I look at it at when if I was an investor 6 days ago in ICICI Securities, I should not be complaining because I'm getting a good deal. I got a good 15% higher price to my stock on the merger ratio. It's the people who bought it post the news that came out and after the stock ran up, they are probably sulking about it. But the market obviously was choosing to value them at 530 and ICICI at 900. So they've given a ratio which is favorable to some extent to the ICICI Securities shareholders. And at the end of the day, they don't want to hurt the ICICI Securities shareholders because they are the largest shareholder in ICICI Securities, right? They own 70+% of ICICI Securities. So it's been done in a way that is good for the shareholders. I don't see it as a negative. My only question is, what was the need to delist this company for ICICI Bank? Because whatever they wanted, they could have always upstreamed to themselves in the form of dividends. It was not like ICICI Securities was asking for any capital from them. It was a business that was growing independently. So I just didn't see a need for it. But yeah, I mean, they've obviously got some thought process of what they want to do, and they've delisted the company.
Yeah, and overall, if you see, the stock has nearly not done much since IPO as well, and the IPO itself did not get fully subscribed. So there were, and the price in today's date post the announcement has moved higher, but otherwise it was at those 550, 580 kind of levels, which was very much the IPO price band as well overall. So let's see how investors take it up from here on. Thank you, Samir, so much for joining us on the show and giving us those views on the movers and shakers in trade today. Thank you. Stay safe and have a great weekend.
Thank you very much for having me, and good luck to you guys. Thank you.